Why a recession would likely cause a catastrophic economic crisis unlike anything the US has ever seen. With the word recession on everyone's lips and the US seemingly teetering on the verge of a slowdown, it's important to consider what a recession actually looks like. Luckily, we have the data and will show how a garden variety recession could very well plunge the country into an imminent sovereign debt crisis. In this video, we'll dive deep into the math showing why a recession isn't just bad, it's potentially catastrophic. So a couple baselines we have to establish. First, here we're looking at tax revenue. This has grown roughly in line with the overall economy at about 16 or 17% of GDP, all the way going back the past 75 years. However, federal spending, government spending, has grown 2 times faster than GDP, going from about 11 or 12% to 22 or 23% of GDP. Now, remember, the deficit is the difference between government spending and government revenue, and we'll get to what happens during a recession. But as you can probably tell from this chart, we can see the deficit as a share of GDP gets worse. And this is what's happening today is what's known as a pro-cyclical deficit. So we are running a 7% budget deficit as of the most recent data, despite the fact that we are not in a recession, nor a geopolitical conflict like a world war. This is what's known as a pro-cyclical deficit. Generally, the government runs a deficit during a recession to help stimulate the economy and due to other reasons we'll outline in a second here. But then as soon as the recession's over, that economy has recovered, you bring that deficit back down. Well, over the past 25 years, we have gone from a 2% surplus to a 7% deficit, despite the fact that unemployment is basically flat, indicating, again, aggregate economic health. Of course, U3 unemployment is not the most a broad way to measure the economic health, but this is just talking about kind of aggregate data. So here is gross interest as a share and as a share of government spending, and interest as a share of tax revenue. So $1.2 trillion as of the most recent data per year in interest. This works out to $3 billion per day. 17% of government spending is interest, and it accounts for 23% of tax revenue. So for every dollar of tax revenue, if we did not run a deficit, 23%, 23 cents of every dollar would go to interest, about a quarter of all revenue going to interest, just interest. Medicare has grown about 700% faster than tax revenue or GDP since the early 70s, going from just about 4 or 5% of tax revenue all the way up to 24% of tax revenue. Social Security has gone from about 16%, 17%, all the way up to 32%. Social Security plus Medicare, just adding those two things together, and you're already over half of tax revenue at 56%. Once you include interest to Medicare, Social Security, you're talking about 79% of tax revenue. And of course, once you add in Medicaid, federal Medicaid spending, you are at 100% of tax revenue. Now, of course, this is not possible because you have to fund all these other federal government programs. You can't have 100% of your spending, of your tax revenue going to spending. So, of course, we have to fund the other programs with deficits, and the deficit, as we can see, is just getting worse. So why does the deficit get worse during recessions? Well, here we're looking at tax revenue. We can see the decline in tax revenue for the past 3 recessions. We have to look at the modern U.S., the modern era in terms of the U.S. economy. We've become far more financialized than we were in the 70s or 80s or even 90s or early 2000s. So we have to look at recent history. And we can see revenue goes down by about 22%. Well, revenue right now is about $5 trillion for the government. In a garden variety recession, we would have a decrease to $3.9 trillion of revenue. Now, here, obviously, the stock market is falling because, of course, companies' earnings are falling because the economy is shrinking. And we can see the drawdowns in the S&P 500 for the past 3 recessions, on average about 46% drawdown. That would take the S&P 500 down to about 3,500. Now, I am going to try something slightly slightly different. Try to keep this video short. But if you're interested in some of the channels that get affected in particular with a declining stock market and how that affects revenue, you can pause the video and read this slide. Here is what would happen to the market cap. So it would go from about $65 trillion down to about $35 trillion. Well, that would be a decrease or a destruction of $30 trillion of wealth. Now, we established revenue is going down. And remember, the deficit is the difference between revenue and spending. Revenue is going down, falling stock market, falling. People are losing their jobs and becoming unemployed. So income tax, a huge driver of overall revenue. Income tax is decreasing because people are losing their jobs, maybe even getting demoted or pay cuts. Therefore, the government's cut, which it is just skimming off of GDP, basically, as we established in the first slide, growing in line with GDP. So if that GDP is falling because people are losing jobs, pay cuts, financial assets are falling, so capital gains tax is going down, that is why revenue is declining. But not only that, spending goes up. So revenue is declining, as we established here. Revenue would go down to about $3.9 trillion due to the various issues that we just laid out that are common, kind of characteristic of a recession. But not only that, government spending goes up. And this is due to two main factors. There's automatic stabilizers. This is automatic spending that you don't need a new act of Congress for the spending to be passed into law. These are things like unemployment benefits, for example. But then you also have discretionary stimulus programs. And you can think of this as the bailout during 2008, PPP loans, the American Rescue Plan, CARES Act, those sorts of things. So discretionary spending and mandatory spending, overall spending goes up by about 27% as everyone is going on unemployment. And of course, there are these fiscal programs passed by Congress, spending programs passed by Congress to try to stimulate the economy and bring it out of a recession. As we can see, on average, spending goes up by about 27%. Well, right now, spending is $7 trillion. 7.1 trillion per year in government spending. This would take the new annual spending number up to $9.1 trillion. We have 3.9 trillion in revenue, and we have 9.1 trillion in spending. That equals a $5.2 trillion deficit. Now, currently, the nominal deficit is about $2 trillion. So that is more than doubling the deficit. But wait, it gets even worse. So remember, in the slide we were looking at here, deficit as a share of GDP, or deficit divided by GDP. GDP, kind of by definition, is falling during a recession because, again, the economy is shrinking. Gross domestic product, or aggregate economic output, is going down. And on average, over the past 3 recessions, it goes down by about 4% during the recession. Well, that would take our new GDP down to 29 trillion from 30.3. Well, again, a $5.2 trillion deficit, or difference between government spending and government revenue. Revenue is going down. People are losing jobs. Income tax is going down. Capital gains tax is going down because financial assets are falling. Spending is going up because of automatic stabilizers and discretionary fiscal spending. You're talking about a 17.9% fiscal deficit. If we go back here, that is up here. That is actually off this chart. 17.9% fiscal deficit, basically unheard of. Remember, GDP is the balance sheet capacity. This is why we have to look at it relative to GDP. GDP is the balance sheet capacity to absorb all the new debt. Because remember, what the deficit really reflects is how much new debt must be issued every single year just for the government to survive. Right now, it's about $2 trillion, or 7% of GDP. Just insane that we have this level of deficit despite everything being relatively okay. 7% deficit. Well, again, the reason you look at it relative to GDP is the economic activity off of which that new debt, that 2 trillion or 5.2 trillion in new debt can be absorbed. Because remember, you have to, if you're issuing 5.2 trillion per year in new debt, there's got to be buyers for the debt, and we'll get to the bond market and the response the bond market might have in a second here. So this is why it's important to look at it relative to GDP. And again, on average, you have the numerator growing, the deficit is growing, increasing, and you have the denominator, GDP, falling. So on average, you can see 400 basis points, 900 basis points, and 1,000 basis point increase in the deficit as a share of GDP. On average, this works out to 800 basis points as a share of GDP. This would take our deficit to 15% of GDP. However, this is only using the official NBER defined recession, but often, as we could see here more recently, the spending continues after the recession is already over. We also saw that back here, of course, with .com and then eventually global war on terror. So once you include peak to trough, it's actually 10% on average that the deficit goes up. And this would take our deficit to, of course, 17% of GDP. As if that wasn't bad enough, it gets even worse. So here, we're looking at the marginal return on each dollar of debt. Back here in the early 80s, we were getting $3.3 of GDP, of economic output, for every $1 of debt that we went into. Well, that's a great return. You should go into debt. And sure enough, we did. The problem is that that marginal return goes down. As your debt to GDP goes up, the return on each dollar of debt goes down due to issues like crowding out. So now we only get 82 cents on every new dollar of debt. And the same is true when you look at the money supply. The return for each dollar, each new dollar printed, the amount of GDP that we're getting is going down. So the return on each dollar of debt or each new dollar of M2 is actually going down. And in fact, it's even worse. So if you look, again, the modern era, past 25 years, we've only gotten 37 cents of GDP for every new dollar of debt that we have issued. So we've gone into $1 of debt and only gotten 37 cents back on that dollar. A $5.2 trillion deficit, if we're issuing $5.2 trillion, again, this is the modeling, just using averages from the past couple recessions. If we have this 5.2 trillion in new debt every single year, if using this 37 cent on the dollar return, we would basically only get 1.9 trillion of GDP. We'd be issuing 5.2 trillion of debt and only getting 1.9 trillion of GDP. However, it's actually even worse because, as you can see, the return has been going down. And the more indebted you get, the larger the deficit, the more crowding out, the more unproductive the debt becomes. As we've seen, the return actually goes down. So we would likely see maybe a 30-cent return in the face of a $5.2 trillion annual deficit, 15, 16, 17% of GDP. But wait, it gets even worse. So generally speaking, in the US, the bond market gets bid. The bond yields come down, bonds get bid during an economic contraction or a slowdown where GDP goes negative. However, in emerging markets that are heavily indebted and kind of in acute fiscal stress, you actually see rates go up, as we see here with Turkey. Well, you might be thinking, yeah, but Turkey's an emerging market. That's too much of a stretch. You can't make that stretch. It's Turkey. It's totally different, not the reserve currency. Okay, well, let's look at Italy. Italy is certainly not an emerging market. They're relatively developed. And here we can see the same thing. During the pigs crisis, we did a whole video on this. I'll link it at the end. During Portugal, Italy, Ireland, Greece, and Spain, they had a debt crisis in the early 2010s. And what did you see? You saw yields or bond rates go up. So you saw bond yields actually go up despite the fact that growth was falling. This is the exact opposite of what we generally see. And of course, Jeffrey Gundlach, one of the best bond traders of all times, runs Double Line Capital. This is a quote from him saying, not only will the dollar fall, generally in a recession, the dollar gets bid as a flight to safety. We know that that's kind of over. We saw that in early April. Dollar's not what gets bid during the flight to safety. It's the Swiss franc, it's gold, it's the yen, it's the euro. So the dollar we've kind of already know that the dollar is going to weaken in a growth slowdown. We already saw that in early April. So his prediction was correct there, and rates will go up. especially at the long end of the yield curve. So again, one of the best bond traders of all time. And again, I will point out that in early April, that is exactly what we saw. We saw the dollar weaken substantially, and we saw the bonds get sold. Therefore, the interest rate or the yield went up. That is exactly what we saw in that first week of April. So I had AI model what it would look like in a recession. What are the odds that we would have interest going up? Because again, if interest rates are going up, we're $37 trillion in debt. Every 1 percentage point increase in interest rate in bond yields equals $370 billion added to that already insane 5.2 trillion. This is assuming that bond yields do not go up. If bond yields go up, as they did in Italy, here about 3% up to 8%, so that's a 500 basis point, 5% increase in their 2-year yield. If we saw that, that would be adding another $1.7 trillion onto the deficit. So you're talking about like almost a $7 trillion deficit if rates go up in the face of slowing growth. Well, that's over 20% of GDP. You are done. You are full blown, monetize the debt. The Fed will be printing money. It'll make 2020 look like child's play to see even a 15 or 16% budget deficit, let alone a 20% budget deficit. Of course, in Europe, we saw the ECB step in, and this is why interest rates ended up coming down. But I wanted to have, AI model this out and take it for what it is, right? It's just AI. But what it said, what it spit out, its base case, which is given a 55% weight, is just a standard developed market recession where rates fall due to rate cuts and QE and kind of flight to safety. Bonds get bid and everything's okay. Rates actually come down, bond yields actually come down. But then you have to factor in that, like in emerging markets, inflation actually goes up during a recession, during an economic issue. You actually generally see inflation go up. So you have to factor in the risk of that. Well, inflation is currently 3.1%. Once you factor that in, the model spits out a probability of 50% odds that inflation actually starts to go up in a recession. Fiscal crisis, this is given a 15% weight, and this is due to unsustainable debt and politicized Fed. Now, we know, we've been covering it extensively, fiscal dominance, which is what Trump has been pushing for with the firing of Lisa Cook and all the attacks on Jerome Powell. Basically, the Fed is no longer independent, right? We are certainly moving in a direction of a fiscal dominance sort of scenario. This also hurts the kind of traditional framework of, oh yeah, bonds get bid, rates come down, no big deal. Probability there, 80%. Currency confidence loss. This we saw in early April. The dollar got sold aggressively. Like there were 3 days in a row where the dollar was down over 1% every day. The dollar got sold really, really hard. That is what you see in an emerging market going through a balance of payments crisis. You see the currency weaken sharply. This is given a 10% weight, and this is due to a loss in the dollar, a loss in U.S. institutions. So again, even if you assume that rates go down, you're talking about a very, very, very large deficit. Again, $5.2 trillion in nominal terms. And here, that works out to 17.9% deficit as a share of GDP, which is, again, what matters. That is you are already at a point where the Fed would have to step in because, again, GDP, the balance sheet capacity to absorb all that new debt, we are already at a 7% budget deficit. We already have issues kind of at the long end of the yield curve, not just in the U.S., but all around the kind of Western developed markets, generally speaking. You already have issues at the long end of the yield curve, and it is very likely, again, Jeffrey Gundlach says the currency will go down, dollar will go down in a recession, and rates, long end rates, will go up in the face of a recession. This is an emerging market phenomenon. And again, we have somewhat of evidence to look to in early April. We also have the Liz Truss moment in the UK where bond yields shot higher and you had a weakening of the currency, right? That is a very developed market, and you had typical EM, emerging market like characteristics, where the currency sold off, the equity market sold off, and you had bond sell off. So yields went higher. Again, 5.2 trillion is assuming that bond yields don't go up. But again, we know that they can. We looked at Italy, and of course, in emerging markets like Turkey, definitely happens. But even in Italy, even in the UK, just a couple years ago, we saw rates go up. So it's actually very likely that, or at least a not insubstantial likelihood that rates would actually go up. And again, for every 1% increase in the interest rate, that accounts to 370 billion dollars, excuse me, of interest expense per year. So you can very quickly have a $5.2 trillion deficit turn into a 6.5, 7, $8 trillion deficit. And remember, GDP, the balance sheet capacity to absorb 5.2 trillion in new debt every single year. You have GDP generally falling during a recession. And again, you're talking about a crowding out effect. Do you really suppose that 5, 6, $7 trillion of new bond supply will just be able to be easily absorbed? The demand, right? When you're talking about the deficit, that is the supply side, supply and demand for bonds. The deficit is the supply side. It is telling you how much new debt, how many new bonds must be issued each and every year. Well, the demand side is, you can think of sort of as GDP. Because again, if demand is constant or even maybe even falling, and you have supply shooting up, more than doubling, right, from 2 trillion to 5.2 trillion, supply is shooting dramatically higher. Demand might be constant. It might even be falling. Well, what does that mean? That means bonds must go down in value and up in yield. So again, it's Jeffrey Gundlach. I would recommend people watch some of his webcasts that he does. He is clearly a very intelligent guy, and clearly finger on the pulse of the bond market, because he called a lot of the phenomenon we saw in early April. He has been calling for that years prior. He has been saying that these things would eventually happen in the US. You would see emerging market-like characteristics where yields actually go up and the currency goes down. Again, the marginal productivity of each new dollar of debt has been falling for 45 years. Looking at the past 25 years in the recent era, we've only gotten 37 cents of GDP for every new dollar of debt we go into. If you're talking about a $5 trillion deficit, again, just garden variety recession, using the averages from the past 3 recessions, you would very likely see that marginal return go down. So anyways, hopefully that was helpful, and I will catch you on the next one.